Now, it's a return of your premium, so the dividend itself is not taxable. So when you sell a participating policy, you're going to want to explain to the client what can they do with their dividends. What are their dividend options? So their dividend options can be remembered. We always want to make a list that helps us to remember what our choices are. Dividend options. So we can take the dividend in cash. Not taxable, like I said. Dividend is not taxable. So that's one of the things you could do. Maybe it's a $100 dividend and you go out to dinner and maybe see a movie afterwards. Depends. It's kind of expensive these days. You can tell the insurance company that you don't want the dividend, but that instead you want to earn interest on it. So they keep the $100 and they pay you interest on the dividend. The interest is taxable. You can choose to apply it to your premium, sometimes seen on the test as premium reduction. So that's a pretty common choice. You figure, if I paid so much in premiums, then what I paid was too much. Just tell the insurance company, why don't you keep it towards my next premium and then I won't owe you as much. So apply to premium. Premium reduction is a dividend option. You can use it to buy reduced paid up insurance. So this dividend choice buys you a teeny tiny whole life policy. So it's a way to increase your coverage without a physical exam. Reduce paid up. The last dividend option is that you can use the premium to buy yourself 1-year term. So you're going to get a higher face amount with a 1-year term dividend option than you will have with reduced paid up, because reduced paid up is whole life. So both of these last choices, number 4 and number 5, allow the insured to increase their protection regardless of health. Dividend options can be chosen and changed by whom? Who has the right to change the dividend option? The owner of the policy. So it is the owner's right to choose and change the dividend option, even if they have an irrevocable primary beneficiary. So the dividend is really a return of premium, money coming back to you that you've already paid. What's your ex-spouse have to say about that? Nothing. It's your money. So you can change your dividend option even with an irrevocable beneficiary. Incontestability. Life insurance policies have a 2-year incontestability clause. What this means is that the life insurance company has to pay claims that occur after 2 years, no matter what. So that the policy, life insurance, is incontestable after 2 years, period. If a client purchases life insurance and dies in the first 2 years, the insurance company has the ability to contest the claim. They're going to look into the claim and try to determine, did the client lie in any way? Did they commit fraud? Was there intentional concealment of a material fact? If the insured dies in the first 2 years, the insurance company always has the right to contest the claim for a valid reason. They can't just deny a claim for no reason. There has to be a valid reason. After 2 years, you're covered. So I always say liars pray for 2 years and then they're covered. How sad, but that helps me. Liars pray for 2 years. Life insurance after 2 years is incontestable, even for fraud. If the insurance company wants to contest a claim that occurs in the first 2 years, what's admissible in court? We learn that the entire contract is what is admissible in court. The policy plus the application if attached. The policy plus the application if attached. If the producer goes to the client's house, collects the application, collects the premium, sends it into the insurance company, and the insurance company, when they're looking over the application, they realize that it's incomplete, that there's areas of the application that were not filled out. Generally speaking, what do you think the insurance company is going to do? Just issue a policy, or do you think they're going to send the application back to the producer, who is then going to need to go back to the client to get it filled out? Yeah, go with the second choice. So anytime the insurance company receives an incomplete application, what they're going to do most generally is send it back to the producer, who's going to need to go back and see the client. Do not just call up your client. You need to go and see them in person and have them finish filling it out. If the insurance company should ever accept a risk based upon this incomplete application, whatever was left blank, the insurance company cannot contest a claim related to that. It's called the doctrine of waiver and estoppel. So sometimes the test will ask you, the insurance company has sold a life insurance policy based upon an incomplete application. What are they doing? They're crazy. Generally speaking, they won't do this. But if they did this, they have waived their rights to contest a claim related to whatever was left blank. Policy assignments. An assignment is a transfer of owner's rights. There's two types of assignments. There is a permanent assignment and there is a collateral assignment. So the permanent assignment we call an absolute assignment. Collateral is temporary. If you want to make a policy assignment, of course you're going to need to let the insurance company know that you're doing this. Absolute assignment. Let's just, for example, I have this policy that is on Max's life, and when Max reaches age 18, I decide to make an assignment to him. So right now, I'm the owner. And Max, he's 9. He's the insured. When he turns 18, I tell the insurance company that I am making an absolute assignment. That's the earliest I could do it, although it does slightly vary by state, but age of majority, 18 or 21, depending upon the state. An absolute assignment to Max. So now he's not only the insured, but he's also the owner. When I first got this policy, who's the beneficiary, generally speaking? I am. I'm the mom, I'm the beneficiary also. So Max turns 18, I want to teach him about managing his money and responsibilities, so I make an assignment to him. Lord forbid he should die. Where's the money going to go to? Max's girlfriend? I don't know. I suppose maybe if Max changed the beneficiary. So the money's going to go to me in that story. When I made an absolute assignment, in and of itself, it does not change the beneficiary. It only changes the right to change the beneficiary. So if Max had changed it, it would have said so in the test question, and it didn't say that, the money would have still gone to me. The beneficiary does not change just because you made the absolute assignment. Collateral assignments are usually done when you pledge your cash value as collateral for a loan. So collateral assignment is temporary. Insurance policies, life insurance policies, always have what we call a suicide exclusion. How long it lasts for varies by state, so that's a law question. But what it does, what it's designed for, is always a general question on your test. Insurance companies have suicide exclusions to prevent adverse selection, to make sure that if someone's buying this policy in contemplation of suicide, that if they commit suicide during the suicide exclusion, it's not covered. So if an insured commits suicide before the suicide exclusion has passed by, there will be no coverage. What will happen is the premiums will be returned to the beneficiary. If an insured commits suicide during the suicide clause, the premiums will be refunded to the beneficiary. Less than loans outstanding, which I suppose could only be the case in a single premium life policy. So if the insured commits suicide, suicide clause does not pass by, what's going to happen? Refund of premiums or refund of premiums, less loans outstanding. Always pick the most correct answer. Sometimes the test is going to have two good answers. One is going to be more correct. It's going to have more information. Always pick, if there's two correct answers, always pick the longest answer. I once had a student tell me she passed the test, but that the longest answer wasn't always right. That's not what I mean. I mean, it's not always right. If two answers are both correct, always pick the longer of the two. And that is a good rule that will help you through the test. After the suicide clause passes by, however long it is in your state, suicide is covered no matter what. Insurance policies have misstatement of age and misstatement of gender clauses. So misstatement of age is always on the test. If an insured lies about their age, they generally lie and they say that they're younger than they really are. Usually we don't lie and say we're older than we are unless we're trying to buy beer. And that's the only time I've ever lied about my age and tried to be older than I am. So when we lie, we say we're younger. So we think we're so smart, but we're really not. So let's say I said I was 40, but I am 45. So I got a face amount of $100,000, or so I thought, and I was paying a $1,500 annual premium, let's say, so that I thought I was so sneaky. The insurance company doesn't really care so much that they know exactly how old I am when I purchase the policy, because when I die, they're going to figure it out. So what happens when someone lies about their age is the insurance company has collected for all these years my premiums. The only thing the insurance company can do at this point, because now I'm dead, is take my premiums and use them at the correct age, and they will adjust my face amount so that the face amount in this story is going to be less, so that the amount of protection that I purchased is less because I was really older than I said I was. So it has nothing to do with adjusting the premiums. They can't get any more premiums out of me. I'm not around anymore. So they take the premiums paid at the correct age and they adjust the face amount. So in this case, they adjusted the face amount down, although the opposite would be true as well. If you said you were 21 but you were really 18, they will take the premiums paid at the correct age and increase your face amount. So it does go either way. Misstatement of age has nothing to do with adjusting the premiums. Always on the test. Settlement or payout options. So the face amount of the policy, let's say, is $100,000. The insured has passed away and the beneficiary wants to know, how can I get my money? We can remember these payout options with an acronym of SIFA. Doesn't mean anything other than helps me remember the payout options. Cash. Most beneficiaries elect cash. It is the only one that guarantees that the face amount is not taxable to the beneficiary. Cash. Take the money and do with it whatever you want. So most will choose that. Interest. Interest is a payout option where you say to the insurance company, 100 grand, I know you could give it to me, but I'll spend it, so you keep it, insurance company, and then the insurance company pays you interest, 4% or whatever it is. So you're not depleting the face amount, you still have 100 grand, but you're just getting interest. The interest that is paid is taxable. The insurance company is keeping the face amount safe for you. You're not spending it, you're not depleting it. Whenever you want it, you can ask for it. It's still your money, you being the beneficiary. Fixed amount. Fixed amount, you say to the insurance company, I would like to get of this face amount $500 a month. So you tell them how much, and then they'll tell you how long, which is different from fixed period. With fixed period, which is another payout option, you tell them how long you want the money to last for, and then they'll tell you how much a month will come to you. So fixed amount pays a fixed amount for a specific period of time, 15 years and 3 months, for example. Fixed period, you say 20 years, and they say we'll pay you $726.14 a month. Who knows? I just made that up. You have to be really careful. Fixed amount pays a fixed amount for a specific period of time. Fixed period pays for a specific period of time, a fixed amount. So they sound very much the same, but whatever comes first in the sentence is what they're trying to get at. If it says fixed amount first, then the payout option chosen was fixed amount. If it says fixed period, then that was what was chosen. Whatever's not being paid out currently is earning interest, and of course the interest that's being earned is taxable. The last choice, which was really why insurance companies originally invented annuities, was, hey, why don't you let us, the insurance company, keep your money and we'll pay you a dollar amount monthly for life. So it is a payout option that you can select as the beneficiary on a life insurance policy. An annuity. It could be deferred, it could be immediate, it could be fixed, it could be variable, it could be equity indexed. And you could have a beneficiary during payout or not, depending upon what annuity payout option is selected. Of the SIFA, of the 5 payout options, which is the only one where you can't outlive the money, to choose the annuity payout option. You cannot outlive the money when you choose the annuity. Accelerated death benefits are also known as the living benefits rider. So life insurance policies have built into them this accelerated death benefit. Living benefits rider. First off, I have to talk about what does this mean? If you think about life insurance, why do you buy it? To protect your family, that's the most common reason. So that it's protection that you won't ever really benefit from. It's something that pays out when you die. The fact that life insurance policies have the accelerated death benefit, the living benefits rider, is a benefit directly for you, the insured, while you're alive. It's something that in the event of terminal illness, it allows you in advance of your face amount. In the event of terminal illness, a portion of the death benefit will be paid to the insured prior to their death. The money must be used, however, for their illness. The money must be used for their illness. So it has nothing to do with cash value. If you're terminal, which does vary by state, but expected to die soon, okay, you can get part of your face amount to be used toward your illness before your death. So that when you do die, what's paid is your face amount minus whatever living benefit you took out. But not alone, has nothing to do with cash value, and there is no interest. So it's built into all life insurance policies today. Life insurance policies will potentially have exclusions. Exclusions are found, like I had said earlier, in the back of the policy. So an aviation exclusion, if you're a student pilot, is very common. Can you pay extra to have coverage for being a student pilot? Sure. Pretty much anybody can buy life insurance, even if you're older or even if you've had some sort of illnesses. It's a matter of, can you afford the premium? So you can get coverage for flying as a student pilot. It just costs more. War and military service are generally, per the contract, excluded from life insurance policies. So war, military service. Now, I'm not saying that if you're in the military you don't have life insurance, and I'm not saying every single policy doesn't cover military service, but for the test, generically, war and military service not covered by your civilian life insurance. It's not that the policy added an exclusion, it's just written contractually within the policy. It's not, specific to just your situation in the military. All life insurance policies, for the purposes of the test, do not cover war or military service. Most life insurance policies don't have many exclusions. Getting coverage is just a matter of, can you afford the premiums associated with them? That concludes our discussion for this section. Make sure you read your key facts. Let me know if you have any questions as you study. Good luck.